As mentioned, I'm going to be taking a deeper look into the private debt and real estate sectors, taking a dive into AUM, dry powder, the fundraising environment, as well as the investor outlook for both of these asset classes. Any questions you do have, please put them in the Q&A box and I'll look to answer them at the end if we have time. If not, I'll definitely get back after the event. So just before I go into the specific asset classes, I just want to touch on the global private capital market to give a bit more color on the topic and to also set the scene a little for both private debt and real estate. We're just going to start with a look at the current target allocations of institutional investors around the world. And as we can see here, private equity, which we also include venture capital, has an average target allocation of just shy of 14%. Moving on to real estate, accounting for a further 10%, private debt around 6.2%, and infrastructure 5.3%. As I've looked back through our previous surveys, you can essentially see the growth in target allocations from institutional investors, and these have been increasing over time. We do expect these to continue in the near future as well. Most investors, when looking towards alternatives, are essentially looking for an alternative to fixed income, and with rates where they currently are, we do expect that trend to continue, as I said. Moving on to a snapshot of private capital AUM, what we can see here is over the last 10 years, quite a substantial increase across all asset classes. So starting in 2010 on the left, with an AUM just shy of $3 trillion to 2020, where there is around $8.5 trillion in AUM across private capital asset classes. I think what's interesting about this growth is that we can see in the first 5 years a relatively modest CAGR of 9%. However, when you look at 2015 to 2020, this accelerates up to 15%. Now, for the right-hand side of the chart, we have our own Preqin forecast for the next 5 years through to 2025. We still expect to see this acceleration in CAGR, as can be seen here with a 17.1% increase compounded annually. This equates to a total AUM across private capital of $18 trillion. Just quite an astronomical figure for the alternative asset class. One of the main assumptions we have within this model is that we're going to continue to see relatively low government bond yields. And whilst we are expecting that to continue in a similar vein, inflation is all over the news and is a material risk to this. If there is sustained inflation, we could see a sell-off of long-term government bond yields in response to that, which would then start to unravel the story which is slightly driving the private capital AUM growth. Now breaking down that forecasted growth, both via asset class on the left, as well as region on the right, we can start to paint a more detailed picture of that growth in AUM. I think the item of note on the chart from the left is private equity is still going to be the main driver of AUM growth, with 140% forecasted growth over the next 5 years. However, infrastructure and private debt are both forecasted at over 100% increases over the same time period. Now looking towards the more regional aspect of it, one thing which we did originally forecast was the exceptional growth from Asia. However, there have been some material downside risks to this assumption, as we've seen the deterioration of relationship between the US and China, which we could feel have a negative impact on cross-border capital flows into private capital. This, alongside a string of regulatory crackdowns across varying sectors, from big tech to education to video games, and then obviously the one that's right at the forefront of the mind at the moment, which is Evergrande. Whilst we don't believe it will lead to a global economic fallout, due to the tight grip that Beijing has on the situation, we do see a threat to the real estate market, where essentially, if that growth engine is switched off, then that would have a much more serious ramifications for not just China, but also the commodity intensive emerging markets that feed into that growth. Yes, the presentation will be shared. Sorry, I've just seen that across. So I believe it should be linked above and we'll share it afterwards as well. Now for a deeper dive into the private debt environment. So private debt has emerged as a core alternative asset class after the global financial crisis and has again proved its worth in the last 18 months. With the COVID-19 driven slowdown, pushing total assets to new highs. AUM has increased to over $1 trillion as of December 2020, making private debt the third largest among the private capital asset classes behind private equity and venture capital, and then real estate. Looking at that strategy split, I don't think it should come as a surprise to anyone that direct lending and distressed debt continue to drive this growth in AUM, especially in a year where companies who are thought to be financially sound started looking for emergency capital alongside the easing off of government stimulus, which we'll start to see coming to the fore, which we also expect to lead to increases in restructurings and insolvencies. Now, taking a look at that AUM, but its composition via dry powder and unrealized value. And at December 2020, there was almost $400 billion of committed yet uncalled capital sat within private debt funds. Quite a huge figure just to be sat waiting to be used. So that figure, there's a few reasons why I believe it. So there was obviously a combination of reduced M&A activity whilst we were waiting to see just how COVID-19 would shake out across the markets, as well as an abundance of liquidity from other debt pools. That slowed the deployment rates, as well as increasing competition within the sector. So now what I want to focus on is the fundraising environment for those managers of private debt funds. When I was doing this presentation, one of the interesting things that I found was private debt was the only asset class to see an increase in the capital raised for 2020, as well as the only one that actually saw a flat number of funds closed. So we can see in 2020, there was around 248 funds closed and $163 billion in aggregate capital raised. I'll later show the real estate, but that was down on both counts of funds and aggregate capital raised. Private equity, infrastructure, natural resources, it hit them all hard. So when we were trying to think of reasons about this, there were a few that came to mind. The asset class is becoming more prevalent, as can be seen by the allocations at the start. Investors could be looking for more downside protection, but not wanting to allocate to the historically low rates within fixed income. And also to the more opportunistic side of investors betting on restructurings and bankruptcies. Lovely. And now just a slightly more deeper view of that fundraising environment. And what we're taking a look here is the proportion of target size achieved over time by private debt funds. For 2020, I think the interesting takeaway from the bar on the right is that although we've seen a relatively stable amount of funds raising way above their target, so that's the 125% or more, which is roughly around 23% over time, we're starting to see a bit of a seesaw effect between those that just raise above target and those that just don't meet, specifically within that 50 to 99 range and that 101 to 124 range. What I think this alludes to is that for the less experienced managers who may be raising those smaller those funds with the smaller brands, the fundraising environment for them is particularly tricky. And I follow this up in the next slide. So this is now showing the proportion of aggregate capital raised by private debt funds, but ranked by the largest. So the blue being the amount of capital raised for the total market by the top 10, then the 11 to 20, 21 to 50, and then everyone outside that. In 2020, almost 40% of all aggregate capital raised by private debt funds was raised by the 10 largest funds. I just think we need to process that for one more second. Like 10 funds accounted for 40% of all of the debt allocated. This capital consolidation amongst the larger players is something that we have seen prevalent across all asset classes. And again, I'll touch on for real estate, but it's incredibly prevalent within private debt. This could be driven by those larger managers who typically raise these larger funds. They have that track record behind them and the experience, and investors are looking somewhere slightly safer, maybe, don't want to take the risk on the inexperienced managers. So now I want to take a look at the similar themes, but again, diving deeper into real estate. This is the real estate AUM by strategy. And what you can see here in the green and yellow bars is that value added and opportunistic continue to dominate the real estate space. And 2020 was no different. In December last year, value added was around 315 billion of real estate AUM, and opportunistic was around 374 billion, which combined equated to around 60% of real estate AUM was tucked between two strategies. I think the other notable thing for this chart is that the increase of private debt. So if you look back at December 2016, the blue bar, $119 billion in AUM within real estate debt, up to 215 billion at the end of last year. I think it just goes to show that as investors become more sophisticated, they are looking at the diversification that they can have within each of their individual asset classes. Again, just doing that AUM split out just via unrealized value and dry powder. Similar to private debt, real estate funds have around $400 billion in dry powder. Again, just a huge amount of money sat with these managers waiting to be deployed. As you would expect during the year or the 18 months which we've just had, a lot of funds and investors put real estate on pause just to see how the market would shake out and see if there are any additional opportunities to be had. So I could have put this chart up for any asset class we're seeing, but I think it's particularly relevant within real estate. It's something which we're seeing across all asset classes, but it's that the capital called up by managers is now outstripping the distributed capital back to investors. And as we can see here, 2020 was the first year since 2012 where the net capital distributed was negative. To be honest, there's a few reasons why this could happen, but again, growing size of the market, more recent vintage funds, harder to put that capital to work. It's kind of a myriad of reasons within. So as I alluded to when we were looking at the private debt side, when you're looking at the real estate fundraising section, the one part of this chart that's staring back at us is the incredibly sharp decline in both number of funds closed and aggregate capital raised since the peak of 2019. So 2019 was the record year of fundraising, raising around $185 billion. In 2020, that declines to a shade under 149 billion. And at the moment, we're currently sat at around 97 billion for 2021 so far. But what really shows how much of a competitive landscape is, and also the bigger funds taking that larger portion of the pie, is that there was a drop in number of funds closed from 565 in 2019 to 409 in 2020. So over 160 funds fewer closed that year than the year before, equating to around a 28% decline. Now this chart is showing the aggregate capital raise, which I've spoken about before, but this is now split up by region. So when you break it down across the 4 regions which we have, so these are regions where the funds are focused on investing, between North America, Europe, Asia, and rest of the world, you can see that North America focused vehicles were the hardest hit in 2020. Europe, Asia, and rest of the world focused funds all staying relatively flat when you're looking at the aggregate capital raised. Whereas for North America, the aggregate capital raised by those vehicles dropped by almost 40 billion. Again, that's just a huge decline from what is usually seen as the more dominant market within real estate. And just to really hammer home how tough the fundraising environment is, what we're seeing now is, again, the proportion of aggregate capital raised by the largest real estate funds. So 28%, on average, we're seeing around 30% is raised by that top 10 largest funds. So 28% of capital was raised by the largest funds in 2020. And even more starkly, if you go back to 2019, over a third of all capital raised for private real estate funds was collected by the top 10 funds, even in that record-breaking year. So having taken quite a lot of a look at the historical data, as well as that view being more from the manager side, what I now want to do is to take a look at the investor outlook. So we're going to take a look through the plans for the next 12 months, the challenges that they see across both real estate and private debt, and also where they're going to be putting their money over the next 12 months. So we do 2 investor surveys across the year. This data here was from our investor outlook report for H2, and it was surveyed in July. We asked investors a variety of questions. It could be on the expectations of the performance of portfolios, where they're going to be looking to invest their capital, and then obviously like the largest challenges which they feel will be affecting their portfolios. And what we can see from this chart is that most investors feel the portfolio for private debt and private real estate will perform about the same. So it's roughly 55% between the two of them. One thing which is worth noting is that almost 20% of investors believe that their private debt portfolio will perform worse in the coming 12 months. And this is the third highest proportion behind hedge funds and natural resources. When it comes to the investors who believe their portfolios will perform better, private debt ranks at the bottom with 26%, and real estate is equal third, with over a third of investors believing that it'll perform better over the coming 12 months. Private equity clearly have the most optimistic investors, with over 45% saying that their portfolio will perform better over the coming 12 months. Following on from those expectations, we asked managers whether they're looking to allocate more or less capital to the respective asset class than the previous 12 months. So we can see across private equity, venture capital, and private debt that around 40% of investors will be looking to increase allocations to those asset classes, with infrastructure really taking investors' fancy, with over 50% say they will be looking to allocate more to that longer term asset class. The 2 asset classes here which may have fallen below expectations, with almost 40% of investors saying that they will allocate less, are natural resources, which is still what I would class as the alternative of alternatives, and then hedge funds, which over the last few years have lost a little bit of the shine that they once had, be that because of performance issues or fee structures surrounding those vehicles. So we've seen that AUM is increasing and growing at a faster rate than in the previous 5 years. We've also seen that there are large piles of cash set amongst all types of private capital funds, and that investors are looking to put more money into the private capital space. So if you put all of that together, it means that there's obviously going to be more competition within all of the asset classes. And a nice way to show this at the moment is the number of funds in market across each asset class. Just looking at private debt, at the moment, there are currently 690 private debt funds in market, currently targeting around $293 billion in dollars. And then to put that in perspective, around 5 years ago in Jan 2016, there were around 270 funds. So that's almost tripled in 5 years. And the number of funds which are competing for that capital. And then alongside that, it was $118 billion in aggregate capital targeted. So increasing competition, clearly seen even from funds in market, which nicely leads on to my next slide about the key challenges that investors see for return generation. So again, we asked investors their views on where their key challenges are and for over the next 12 months. And as I said, it was a nice lead from the previous slide. Competition for lending opportunities ranks as the largest key concern investors have, with over 55% of investors saying that this is one of their key issues. So again, if you're able to differentiate yourself and your pipeline within the market and show that you can keep those lending opportunities alive, that will go a long way to alleviating some fears investors have. As I said, this ties in with everything we've seen between record levels of funds in market, but also seeing a lot of extra capital being pumped into the system. So it's not just private debt funds you're competing with, it's any other pool of capital that is there. Regulation and then geopolitical landscape follow as the next key challenges. But for private debt investors, it's clear to see that competition is the main concern on mind. So we've looked at concerns and challenges over the next 12 months, and we're just going to take a look at the fund types presenting the best opportunities within private debt. So this is showing you the responses over time. So you've got June 19 on the left of each column and then June 21 on the right. And I think what's interesting to note here is distressed and special situations shot up in June 2020. Everyone thought there was going to be a market of insolvencies and restructuring. And now investors are seeing that there may be not quite as much and has dropped back. And you've dropped 40% for distressed debt and 20% for special situations. Whereas now direct lending is the top fund type for investor opportunities, followed by special situations and then mezzanine. So following on to real estate, I say this on most slides, we're looking at record levels again of funds in market, but this one is staggering, almost 1,300 funds competing for capital. And they're targeting $365 billion. Considering the record fundraising year in 2019 raised around $190 billion, it really goes to show A, how much capital these managers think is in the market, and B, how much investment is coming from the investors themselves. So having asked the same questions to real estate investors and their views on key challenges, I don't think it should be too surprising to see the second one on that chart, the rising interest rates. Over the last few years, as it would have been expected in the low rate environment we've been in, rising interest rates has always been pretty much to the bottom of this survey. And it has just shot up to the second most prominent key concern behind asset valuations, which has been the top concern over the last 5 years. COVID-19 will and may have caused a slight price correction in certain asset types, which could maybe account for that decrease there. But again, it's competition for assets alongside private debt that has really come to the fore as a key concern for return generation. And then as the same we did for private debt, we're going to look at the best opportunities within real estate from the investor's perspective. And looking at this chart, you would always expect opportunistic and value add to be up there and thereabouts within the best opportunities from an investor standpoint. And then distressed, obviously people thought that there could be some opportunities around from the fallout from COVID. But the point which really interests me on this one is the increase of core and core plus. So that's saying that investors are thinking that there's more secure income producing properties. If handled correctly, there is some real return generation from within that, and it could be something safer to see the storm out. And just quickly, key takeaways. AUM across private capital is currently at 8.5 trillion, forecasted to rise to 18 trillion in 2025. Asia looks to be the driving force behind private capital AUM growth, but it is not without its own headwinds. AUM growth has been backed up by increasing capital commitments and allocations from institutional investors. Private debt fundraising was the only bright spot across all private capital asset classes. And there's continued capital consolidation towards the larger managers and across all asset classes. And thank you very much for listening. I'll just double check.